Hi Chris, how you going?
I'm well, Cameron. Yourself?
Great actually. How was your weekend?
It was good. Yeah, it was my birthday, so
I know.
got to enjoy that, which was
Yeah.
nice. So,
What did you get up to, mate?
Just lunch with friends, and ended up coming into town with my wife and a few other friends. So yeah, it was good.
Excellent. Good
Had
stuff.
a nice time.
Excellent. We're obviously here to talk about this month's economic update. There's been a little bit happening in markets, and we'll just talk about what's been happening over the course of the last month. Anything jump out at you?
It was just interesting in terms of maybe some of the CPI numbers have changed a little bit.
Yeah.
Expectations for interest rates subsequently as a result, compared to the conversation that we had a month ago.
Yeah.
Just thinking, the numbers are, I don't want to say on a knife's edge, but it's just interesting to see how they're changing, and be interesting to see the August numbers and what trend essentially is starting to emerge.
What we're looking at.
Yep.
Well, let's work through some of the key points now. So both the US and Australian central banks were on hold last month.
Correct.
So RBA held at 4.35. The Fed held at the rate 3.5 to 3.75. So there was no change. I think they're probably both looking for a clearer confirmation of
absolutely.
where, to your point, where the direction of things are moving before they make another move.
I was going to say, it seems to be different between jurisdictions, because it seemed there are a few Fed members that were looking for a rate rise in the US.
Yeah.
And so obviously that conversation's maybe not sort of set in stone.
Yeah, I think that was a 9-3 vote from memory. Yeah, so the 9 kept it on hold, 3 wanted to move.
Yeah, and I guess here in Australia, it's like, well, is inflation going to continue? Like, are fuel prices going to continue to push and keep prices higher, or is the weakening consumer confidence going to go the other way here?
It's really hard to have some insight into that too, isn't it? Because of the on-again, off-again war in Iran. And then even again last night, I heard that that it's most likely that they're going to take a deal, according to Trump.
Yep.
I just wonder what happens there.
Yeah. Well, I guess no one knows, right? So
No.
we wait and see.
Yeah. Inflation has cooled a little bit. So in Australia, headline CPI was 3.8.
Yep.
The trim mean held at 3.6. So that's hitting sort of getting closer to target, which is obviously that 2 to 3% range.
Yep. Well, it's just interesting in terms of it's a bit fragile at the moment, because some of those numbers are very heavily driven by energy inputs.
That's right.
So, it's like same conversation essentially.
Yeah. Consumer and business confidence. We had some good numbers there. So they both rose on some fuel price relief.
Yeah. Yep. Which is great.
That's right. So there's still the Australian consumer confidence numbers are still coming off a really low base. But to see a bit of an increase is excellent. US GDP growth, second quarter GDP growth, annualized at 1.5.
Yeah. Well, it's not amazing, is it? Sort of bleak. But coming back to Australia, in terms of our conversation that we had last month, we were sort of, I guess, talking about the fact that consumer confidence plays such a large role in, I guess, the GDP number. You're right. It's nice to see a lift.
Yeah, nice. Good to see a good number there. The housing correction in Australia.
Yeah.
We spent a bit of time on this last time, actually. So it's continued to deepen.
It has.
Auction clearance rates in the low 40%.
Yep.
And those numbers are slightly manipulated too, I think, in the sense that if people aren't going to, if they don't think they're going to sell at auction, then people will rip it. We'll stop the auction and try and sell it via private sale.
Yep.
And when you have deep dive into some of those, you're looking at sort of like the 15 to 20%.
Yeah. It's
clearance rates across Australia.
It's in the major, Melbourne, Sydney, capital cities. It's a big change. It'd just be interesting to see how that actually flows through actual affordability in terms of because the rates have come up, then lending is subsequently reduced. So it's from prices are coming back in Melbourne and Sydney, but at an actual affordability level, like what has that actually sort of really changed things?
So from an affordability perspective, I was thinking about this before. What makes house prices more affordable, right? So we think about the drivers of that.
Yeah.
interest rates being one.
Correct.
So
Well, it's huge.
if
Yep.
the average price of a house in Melbourne is it's just tick under 900,000. So if interest rates are at 6%, then the interest you're paying on that is, if you borrow the lot,
Let's
is
just call it $1 million
54,000.
for easy
No,
maths.
I can do the math. It's 54,000
Yep.
in interest. Versus, when we were coming out of COVID, we saw interest rates at the 3%,
Yeah.
right?
Yep.
So you got a $900,000 mortgage. The interest you're paying on that is 18,000.
Yeah.
So in this instance, the cost of buying a home has increased threefold.
Yep.
Right, because you were paying 18, 36.54. You're now paying 54.
Yeah, correct.
So it's
Yep.
threefold increased. So the cost to buy a home is significantly more expensive than it was back
Yeah.
in COVID days.
Yeah, it's funny you say back in COVID days, it was only like 4 or 5 years ago.
It was a while ago now. Yeah.
But
Yeah.
in relative terms, it's not that far. Yeah.
No, it's not. That's right. Other things that drive the price of houses,
Oh, my brain's gone.
population growth.
Population growth, yeah. Sorry, thank you.
Yeah, that's okay. So more people buying homes, more people here wanting to buy homes.
Yep.
That's obviously also challenging. But I think primarily what drives the costs of buying a house is actually not the price of the home, but what it costs each month.
Yeah, absolutely.
Right? Because not many people are pulling $900,000 of cash out to buy a property.
Yeah, well, very, very few. Yep. Especially with where wage growth has been for the last decade or so. It's other than maybe that COVID period where we were all forced to be at home, where our savings rates were through the roof, and I'm sure we had that chart up last week, but household savings rates are not flush.
No, that's right. It's hitting about 6-7%, I think.
Yep.
Disposable income at the moment. So where to now with house prices? Do you think?
I wouldn't be arrogant enough to make a prediction. Really,
Yeah, there was a couple of studies that we pushed out last month. One by Domain that talked about house prices falling 7 to 8% as a result of the budget.
Yep.
That's a pretty significant number.
That's
So if you're a
a big
first home
number.
buyer,
Yeah.
maybe you bought 12 months ago, you're paying your $900,000 to buy a place, and it's fallen by 8%. It's most of your deposit, Chris.
Well, it hurts too, right? Because when you're underwater in any investment, whether it be housing or otherwise, the emotional effect that has in terms of then what your outlook is significant. So I think, but then that also plays into consumer confidence, right? So which then impacts wider growth. So it's not just it's the secondary, tertiary impacts of all this sort of stuff that has an effect.
Yeah, that's exactly right. Yep. Should we move to equity and bond markets?
Sure.
So these numbers are updated to the 31st of July, so to the end of the month. During the course of the month, US equities basically didn't move. They fell by 0.06%. Global equities fell by 0.69%. Aussie equities were up, buck the trend, 1.25. Aussie bonds are up. That's a lot in a month, like 1%,
Yeah,
0.96.
bonds, yep.
Global bonds similar. You extrapolate this out, look at, say, the 1 year numbers, US equities, this is defined by the S&P 500 over that period of time, are up just a tick under 20%, Chris.
It's crazy, isn't it? When you look back and you think about the news cycle that's happened over the last 12 months, and then I always equate this back to like pre-GFC, where we had those couple of years in a row that was sort of like 20, 25, 20. But the news at that point was like, things are flying, everything's great.
Yeah.
The government was throwing money out because it had more money than you could, it was like golden days. Whereas at the moment, the news cycle, I don't know whether that's just a shift, but there's been a lot of pessimism in the news, but then markets are up 20%.
Yeah, I think how people get their news has changed. I think if you think back in 2008, it was all about the big headline in the Herald Sun or the Age or the Fin Review at the time the next day, and that's how you got your news. But how people get your news now is on your
instantaneous
on your phone. It's instantaneous. The sound, the 5-second sound grabs that sound good.
I think I just reflect on all that. Like, I don't mean this to be dismissive, but in terms of a lot of the conversations I know I've had with clients over the last 12 months, there's been a lot of hand-wringing and worrying about like where things are going to go. It's just another I guess, example for me is like you have to just look through the noise. Like you can't address it on a short-term basis because you miss this, right?
Yeah, that's right. And if you miss this uptick in global equities or world equities or Australian equities, and even if you're in your balanced portfolios in the last 12 months have still done their 8 to 12%, right, depending on what you're in. So you can't you've jumped out because it got too scary.
Yeah, correct.
12 months ago.
Yep.
You're not making that back.
No, you do. Yeah, but then also it reduces your ability to absorb the shocks when they do eventually come.
Yeah.
So say, for example, the COVID one was sort of 15%, but then recovered, and then we had the Trump tariff one that was probably somewhere between 8 to 10%, but then sure those things have happened, but the recovery and the then subsequent accumulation post those periods has dwarfed them really.
That's right.
But again, looking through the emotional decision making.
Just looking at these 3-year numbers, US equities actually done. This is compound 19.3 over over 3 years. Yeah, so on a per annum basis, global equities mainly influenced by US equities have done 19.7, and Aussie equities still lagging significantly from the global market. We touched on this last time, didn't we? That sorry, you were going to say?
No, I was just thinking about it. I was like, well, that's 19. Let's call it 20. Round up because I can't. My maths isn't quite good enough.
Let's call it 20.
Your maths might
20
be.
and 10 or 20 and 11. Yep.
So 20 per annum over the last 3 years. So that's 60%. So, wow, yes, I'm simple math.
Yeah.
Even if we get because a lot of the conversations I've been having with clients recently, a big AI correction, let's call it a 40% correction.
Sure.
Like, there's been if you've missed the last 3 years, even if there is a huge correction here, you're buffeted because you've done well on the way up.
Yeah,
so
that's right. Yeah.
It's one of those, I guess, again, the discussions where you've got to take the good with the bad, essentially, and this is the risk play in a sense.
Exactly. Yeah, that's exactly right. Hey, should we talk about bonds?
Sure.
So, do you want to? Can you talk us through how bond markets work? Is that too broad a question?
Well, it's a very big question. I was like, well, again, you're probably assuming too much of me.
All right. So what are bonds? Let's start there because people don't really understand what bonds are. Right. We can explore the intricacies around how they move.
Okay, so a bond is a promise by a supplier, whether it be government or a company, to pay you, I guess, what we call a coupon or an interest rate back over a set period of time. Let's call it 5 years or 10 years or 30 years. And then you get what we call your face value, or like I equate it to kind of like a term deposit. So you go to the Australian government, they're going to give you a 30-year term deposit at, let's call it interest rates of at the moment, let's call it 5%. And in 30 years' time, you'll get your let's $1 million back, whatever the number is. Yeah. Plus you get the interest costs along the way.
Yeah.
The only difference between a term deposit and a bond is then traded on a secondary market. So its price moves day to day depending on what interest rates are, and it has an inverse relationship to interest rates.
So right at the thanks, that was a really good explanation.
Sure.
So right at the moment, let's say the bond market, the Australian government's issuing bonds at around about 4.5% over a 10-year period. So essentially what that means is if you buy that bond from the Australian government directly, then every year for the next 10 years, you're going to get a coupon of that 4.5%, which will continue. And then in 10 years' time, because you invested, if it's $1 million, you've invested your $1 million. 10 years' time, the Australian government, because they're lovely, they'll give you $1 million back, right? And they've paid you 4.5% along the way. One of the challenges in the bond market, though, of course, is as interest rates move around, depending upon what's happening in the economy, as interest rates move around, then we then get a situation where maybe in a year's time, let's say interest rates increased, heaven forbid, if interest rates increased, in the bond that the Australian government might be issuing in a year's time, let's say they increase to, say, 6%, they might issue a bond at 6%. Now, if you bought a bond today at 4.5%, and then in a year's time, you could also buy exactly the same bond, which matures a year later, of course, but the same bond at 6%, then subsequently, how many people are going to want to buy your bond on the secondary market? At 4.5%?
Less.
Less.
Yeah. So therefore, price is lower.
So what happens to the price of that bond is it falls in value, right? So you don't end. So for you to be able to get something like an equivalent of 6%, the value of your bond's going to fall if you want to sell it on the market.
Correct.
If you want to sell it on the market.
Correct.
In the secondary market. And so this is why we've seen bond prices move over this period of time, and why bond returns have been pretty poor because we saw
it's been
interest
terrible.
rates ratchet up
Correct.
from in COVID 2-3% to now much higher than that. So thinking about bond market returns over that period of time, the 1 year number for Australian bonds, the index has only been 1.5%.
Yeah, it looks shocking when you're looking at it in a nominal sense. You're looking at it going, well, why on earth would I do that? And I guess bonds during that period probably didn't play the role that people necessarily maybe wanted them to.
Probably just didn't get the expected return.
Well,
that
this
they
is
wanted,
They were still there as a ballast or an offset for equities. But I think there was a period there where people were thinking, well, I would like my 4 or 5%, please, which just isn't a reality in those environments.
That's
Whereas
right.
We're probably more likely back to where you would typically want it to be.
Yeah, so now is a much better time to be holding, in hindsight, be holding bonds, of course. But they still acted as a ballasting balanced type portfolios over that period of time. What's coming up in the next few weeks? So we've got an RBA cash decision next week. The 4 major banks are expecting a hold at 4.35. I guess we'll see.
Data led.
That's what's being expected. In the US, it must be later this week, I think. There's the US July jobs report that's coming about, going to come out. So that's it followed a pretty weak print of 57,000 jobs last month in June. We've got the US July CPI numbers, which will, I guess, confirm whether June's disinflation continued. And we've got Chair Walsh's first appearance at the Jackson Hole Symposium, which is the latter part of this month.
That'll be a very interesting. Well, I want to say important in a shorter term context. In terms of where's the Fed headed and what's the views.
Resetting rate expectations, which will impact bond markets and equity markets, of course. And then we've got the Australian July CPI monthly print near the end of the month. Takes them about 4 weeks to work out what the CPI was last month.
Waiting for all the data. But
that's right. And so then that'll give us an early read into the September RBA meeting. Chris, is there anything else you wanted to talk through?
Not really. No.
It's from my perspective, the way I'm reading this at the moment is it's almost steady as she goes. So the data is not really that much change from where it was last month.
Not at all. Yeah.
Portfolios are still doing well. And I guess we'll just see what comes.
Yeah, well, there's no. Yeah, I think we're ultimately looking for a trend, and there isn't a clear trend at the moment. Whilst that happens, things are gonna sort of bop around up and down. But yeah.
Well, thank you. Thanks for your time. Yep, appreciate everyone listening. If you got to the end, we'll see you next month.
See you next month.